It's no secret that inflation has been hurting American households, and policymakers around the world have been playing catch up with inflation. This, paired with the fact that inflation has outpaced wages, means that real incomes in the US have been declining since 2019, which means the only way people have been able to afford to buy all the things that they are still buying is by relying on credit and pushing debt limits to all-time highs. But the fact is, the concern that is on the horizon is not inflation. The real concern is actually deflation. I know that most disagree with me on this topic, but there is a reason this channel is called Heresy. So what is my reasoning for this? What do I see unfolding right now that makes me see deflation on the horizon? I'm going to explain how this works by illustrating the Austrian business cycle theory, and then we're going to take a look at where exactly we are in this cycle. Because if you want to prepare for a storm, it's probably a good idea to know whether it's winter or summer. Now, most people are familiar with the business cycles. There's years of growth, there's years of decline, nobody really knows why. And when you ask somebody who's an economist, the traditional Keynesian economist type, they'll attribute the growth years to something that they chalk up to something called animal spirits. But really, there's no such thing as a business cycle. It's a debt cycle. Imagine with me for a moment, we've got a small, isolated, imaginary economy with just 10 people in it. These 10 people buy and sell from each other, and each of these 10 people has $10. So this local economy only ever has $100 total. They buy and sell from each other, they make goods and services, and the money exchanges hands, and sometimes some people have more, some people have less, but in total, they've got $100. Now imagine the town gets a new member. Somebody moves to town, and this guy is a banker, and he's able to convince everybody, hey, your money is not safe with you. Somebody could break in, somebody could steal it, your house could go on fire, and you have your money burn up. Instead, give your money to me, the banker, and I will keep it safe for you. When you make transactions with each other, instead of coming to the bank to withdraw your money to make the transaction, I'll just credit it to the new person's account. So if Johnny buys something from Sally for $1, then I'll move $1 from Johnny's account to Sally's account. No money has to actually trade hands. It can all stay safe, and it's much more efficient that way as well. People go about their day-to-day lives, transacting with each other, and nothing really changes. But then the banker starts his next plan, phase 2, which is loans. See, before, if Johnny wanted to borrow money from Sally, then that meant he was going to be spending Sally's money, which meant Sally couldn't spend that money. So debt did nothing to the total supply of money in this economy. There was still always $100. But now the bank is going to offer loans, and they're going to be loaning that money into existence. So Johnny wants to borrow money, but Sally is asking too much interest. So it's too expensive. Johnny says no, but he sees the banker is now offering a loan at a much more attractive interest rate. So he says, hey, it's worth it now because that's a cheap enough interest rate where I'm okay taking out debt at that rate. So he goes to the banker and he says, hey, bank, I'd like to get a loan of $5. So the bank says, absolutely. Now your account before had $10, now it has $15. Go and spend it as you'd like, and you owe it back to me with interest at a later point. Those $5 were loaned into existence. They weren't moved from one person's account into Johnny's account, they were loaned into existence. So now he goes out and he takes that money, and let's say he uses it to repair his roof. Well, that's money he would not have spent otherwise. If that cheap loan wasn't available, that's money that he wouldn't have spent. But now he spends it to repair his roof, and now the roof repairman has income he wouldn't have had. So now that roof repairman is able to go buy that new pair of shoes that he wouldn't have been able to afford beforehand. And now the shoemaker has more demand. And so the shoemaker says, look, to keep up with all this new demand, I've got to hire a new employee. So he hires a young new employee to help him improve and grow his operations. And the whole thing continues down this cycle. Everybody has more expenses, and that means the next people have more income, and so on and so forth it goes, driving prices and incomes higher. This sounds amazing, right? Inflation-induced growth. But we have to remember how this all started. with a 4-letter word called debt. Johnny owes $5 back to the bank. And so at some point, what Johnny has to do is he has to take some of his income, which may have increased, may have experienced an increase as a result of that new money working its way throughout his economy. He has to divert some of that income and take it back to the bank and pay off that loan. The moment he does that, he's taking money out of circulation, and now he doesn't have as many expenses, the ability to spend money like he did before he paid that debt back. So at this point, the cycle starts to unwind then, because John spends less money because he paid off debt, which means whoever would have received that extra spending now doesn't, which means they don't have the income to spend where they were going to spend, and the whole thing unwinds. All the prices start to come back down. The shoemaker loses business and has to fire that new employee, and this is the bust. The last step in the classic Austrian business cycle theory, the boom-bust cycle. The bust is made inevitable because the boom was created off of the expansion of the money supply, which was fueled by easy credit. So easy credit, more money comes into existence, prices go up as a result, malinvestment takes place, the deleveraging starts, and the bust occurs. Now you might ask at this point, well, what if that deleveraging never occurs? What if the banker is able to get somebody else to take out a new loan, and then when that person wants to pay it off, they get more and more people to take out a new loan, and you can just make sure that the money supply continues to expand? Well, at that point then, what happens is the prices just continue to go up. Both incomes and expenses continue to go up, and eventually the prices accelerate to infinity. You get a hyperinflationary collapse of that money, which is what Mises called the crack up boom. When instead of letting the deleveraging, the bust occur, central banks try and stop that from happening, and instead the currency collapses. So which path are we on right now? Are we on the path towards that crack up boom, that hyperinflationary collapse of the currency, or are we on the path towards the bust, the deflationary death spiral? We have to take a look at the last couple of years to see where we are. In February of 2020, the money printer turned on and the Fed printed trillions of dollars. At the same time, they lowered interest rates to zero, and even long-term interest rates were close to zero. This led to a spike in lending, a spike in borrowing, and a spike in spending. More money worked its way throughout the economy as a result of easy credit. This caused, in turn, a ton of malinvestment. Almost immediately in March of 2020, the stock market bottomed and asset prices started to race higher from there. Now keep in mind, this money printing was loans. We have to remember we have a debt-based monetary system. So the Federal Reserve printed money, but it was doing that through the creation of loans. The federal government was borrowing that money in order to spend it, and banks were taking those low rates and they were loaning money into existence. New money comes into existence as loans. So when did asset prices stop increasing? Asset prices topped at the end of 2021, beginning of 2022. Coincidentally, that was the same time the Federal Reserve started to raise interest rates. And it was the exact same time they stopped purchasing assets for their balance sheet. Yes, their balance sheet expanded a little bit from there, but that was from the prior purchases of mortgage-backed securities that took a while to settle. They actually stopped their purchases at the end of 2021. This means asset prices started increasing the moment the printer was turned on, and they stopped increasing the moment the printer was turned off. But what about the prices of goods and services, the stuff that people have to buy? Well, even though the money printer turned on in March of 2020, it took a full year before the CPI got back up to the average 2.5% inflation rate. And from there, it skyrocketed to record highs for the next year and a half. And so the money printer turned on, and it took a year for the price of goods and services to start to rise as a result. Just like in our example story, when Johnny took out the loan and then that money started to get spent throughout the economy, it does take a while for newly printed money to work its way throughout an economy and bid up the average level of prices. In the United States, in today's day and age, that time frame is anywhere from a year to a year and a half. But we know the money printing shut off in January of 2022. It's been almost a year and a half. half since then. So inflation should be slowing down, right? Well, since June of 2022, for almost the last year, the year-over-year inflation rate has been falling. And the month-over-month rate at 0.1% is almost zero. So right now we are experiencing disinflation as the inflation rate is headed lower. But what about the deleveraging that we discussed earlier? Because certainly, United States, nobody is deleveraging, right? But when we look at the rate of change in credit card debt, we are actually seeing a slowdown in how fast Americans are loading up on credit card debt. So the pace of borrowing for Americans has started to slow significantly. What's going on here is that American consumers are simply tapped out. Yes, prices are still high, but people are starting to not be able to afford to buy everything at those higher prices. So they're just not able to buy them. Egg prices are starting to fall. Freight costs have absolutely collapsed from the bubble and are now well below levels that they were very normal in 2017, 2018, and 2019. US West Coast port traffic has plunged 37%. Layoffs are taking place all over tech, and every single quarter since early 2022, layoffs have been increasing. Oh yeah, and don't forget the bank defaults. Essentially, the banking situation right now is deflationary because when the assets that banks hold go bad, whether they're worth less and they have to sell them for less than they bought them for, or because they just evaporate like in 2008 and they're actually worthless, that means that the broad money supply could evaporate as well. If the bank goes under, then everybody who had deposits there suddenly has no money. Now, obviously, we know that depositors, right now at least, are getting bailed out, but that doesn't mean that the rest of banks are going to keep on going along and doing business as usual. The shareholders are not getting bailed out. So banks right now are tightening up, and there's a real credit crunch taking place right now. This means that small businesses right now, it is getting harder and harder for them to access credit. And we have to remember, every person's expense is another person's income, and every person's income is another person's expense. So all these signs are positive feedback loops feeding in on each other that point to less money in circulation. This is why the money supply has been on a decline since April of 2022. The inability for people to afford to continue to buy the things at the higher prices is forcing people to spend less. And every time somebody spends less, that means somebody else makes less, which means more and more people are starting to save and again spend less. This process starts to drive prices lower. In aggregate, drives incomes lower as well, which will feed into itself in this cycle called a deflationary death spiral. Just because the year-over-year numbers on the CPI are not low yet, they're still high at 5%, doesn't mean deflation isn't on the horizon. Now, I'll be the first to admit I'm off on my timing here. I've been saying for a while that I thought by now the inflation numbers would be well below 2%. But the fundamental drivers are still driving, and we are still moving in that direction by any measure. And unless the Federal Reserve actually pivots, and no, this recent spike in their balance sheet doesn't count because this does not result in more money in circulation. It simply keeps the same amount of money in circulation. Then we will continue to head in the deflationary direction. So plan accordingly. As always, really appreciate you guys. Thank you so much for watching. Have a great day.